Imagine hiring a contractor to build your house. He smiles, shakes your hand, and says, "Don't worry, my fee is tiny. Just 1%. Sounds reasonable. Then he adds, not 1% one time. 1% of the house's total value, every single year, forever. Even after construction is done. Even if I never improve anything. Even if the house burns down. And I'll quietly take the money from your account so you never have to see the bill." You'd call the police, but millions of people are doing exactly this with their retirement accounts. They hand Wall Street their life savings and agree to a fee so small it sounds harmless, but so permanent it can steal a quarter to a third of their final wealth. And the worst part? Most of them never even realize they're paying it. My name is Sloan, and I spend way too much time analyzing the hidden systems that quietly drain your wealth so you don't have to. If you've ever looked at your 401k, your Roth IRA, or an old mutual fund your advisor put you in and thought, "I'm investing, so why does this still feel like I'm getting robbed?" Hit subscribe. Because today, we're performing a brutal autopsy on one of the most successful wealth extraction machines ever invented, the actively managed mutual fund fee. More specifically, the innocent-looking 1% fee that can erase 25, 30, sometimes even 40% of your lifetime investment gains. It's not your fault. Your brain was hacked, and the system was designed this way. I call this the forever fee trap, because that's what it is. Not a price, not a one-time cost. A permanent toll booth installed directly in front of your future. And it works because Wall Street understands one thing about human psychology. We are terrible at feeling percentages. If I told you a financial advisor was going to charge you $230,000 over your working life, you'd recoil. You'd ask questions. You'd compare alternatives. You'd demand proof that they earned it. But if I say it's only 1%, your brain hears small. 1, tiny, negligible, a rounding error. That's the scam. Because in investing, a small annual number is not small. It is exponential. And exponential math is where normal human intuition goes to die. Here's what the industry knows. You don't experience the fee as pain. You never pull out your credit card. You never get a Venmo request. You never see an invoice that says, "Congratulations. This year we siphoned $4,700 from your retirement account for the privilege of underperforming the index." No, they hide it inside the return. The number you see is already net of fees. The bill is removed before it reaches your eyes. Which means the financial pain is real, but the psychological pain is invisible. And invisible bills are the easiest bills to overpay. Think about how crazy that is. People will drive across town to save 8 cents a gallon on gas, but leave a 6-figure fee leak sitting inside the one account that determines whether they retire at 60 or work until 72. That's not stupidity. That's design. Let's make this concrete. An expense ratio is the annual percentage a fund company charges to manage a mutual fund, or ETF. If a fund charges 1%, that means each year, or roughly 1% of your invested assets are deducted to pay for management, administration, marketing, overhead, and, in many cases, a very expensive office where someone in a quarter zip tells you they're navigating market volatility. Now, on paper, 1% doesn't sound fatal. If you have $10,000 invested, that's $100 a year. Annoying? Sure. Catastrophic? Not obviously, but that's because most people think of fees like groceries, a one-time subtraction. Investing doesn't work like that. This fee is attached to a compounding machine. And when you subtract from a compounding machine every year, you aren't just losing the fee. You're losing every future dollar that fee would have earned for decades. This is the part almost nobody explains clearly. The fee isn't just taking money from you, it's taking time from your money. And time is where all the wealth comes from. So let's run the simulation. Meet Daniel. Daniel is 35. He has $100,000 invested for retirement. He does the responsible thing. He doesn't panic. He doesn't day trade. He leaves the money alone for 30 years. Same investor, same discipline, same market. Only one difference: the fee. Daniel buys a simple index fund charging 0.10%. Let's assume the market returns 7% annually before fees. After the 0.10% fee, Daniel keeps about 6.9%. 30 years later, his $100,000 grows to roughly $740,000 to $760,000. Great outcome. Now let's look at scenario B. Same market, same starting amount, same timeline. But this time, Daniel is placed into a fund charging 1.10%. Not 10%, not 5%, just 1 percentage point more. So instead of keeping 6.9%, he keeps about 5.9%. After 30 years, so his balance is about $550,000. Read that again. Low-cost path, around $760,000. High-fee path, around $550,000. Difference? Over $200,000. Gone. Not because Daniel made bad trades, not because he sold in a crash, not because he lacked discipline, because a fund manager installed a 1% toll booth on his future. That extra 1% fee didn't reduce his outcome by 1%. It reduced his final wealth by roughly 27% to 28%. That is the crime scene, and that's using a relatively simple example consistent with the fee math in your reference material. Let me say that in plain English. You took 100% of the risk. You supplied 100% of the capital. You waited 30 years. You did all the hard part, and someone else quietly walked away with roughly a quarter of the ending wealth. That's not just 1%. That is a partial ownership claim on your life. And this is where it gets ugly, because some actively managed funds don't charge 1%. They charge 1.5%, 2%, sometimes more once you stack in advisor fees, 12B1 fees, plan fees, and trading costs. So let's push the simulation one step further. Same Daniel, same $100,000, same 30 years, same 7% gross market return. Now Daniel keeps only 5%. That $100,000 grows to about $432,000. Now compare that to the low-cost index path at roughly $760,000. That's a gap of over $300,000. And now the fee drag didn't just take a quarter of his final wealth. It took something closer to 40% to 45% of what he could have had. This is why rich institutions fight so hard over basis points. Because they understand something middle-class investors are never taught. In compounding, friction is destiny. Tiny annual differences create monstrous lifetime outcomes. And here's the part that should make you angry. Many of these expensive funds don't even beat the market consistently enough to justify the fee. So you're not paying more for better results. You're often paying more for the comforting story that someone smart is doing something, and that story is worth billions. To be fair, this belief didn't come from nowhere. There was a time when paying for active management felt more defensible. Information was harder to access. Trades were expensive. Research was concentrated. Index investing wasn't as mainstream, and regular people had fewer tools. So the idea of paying a professional to pick stocks felt logical. Back then, expertise looked scarce. Today, You can own the entire US stock market for almost nothing. You can buy broad index funds with fees so low they're almost irrelevant. The product changed, technology changed, competition changed, but the sales pitch didn't. Because Wall Street never sells simplicity. Simplicity is cheap. Simplicity is hard to monetize. Simplicity makes the middleman unnecessary. So instead, the industry sells complexity. It sells access. It sells active oversight. It sells downside protection. It sells the fantasy that your portfolio needs a full-time adult in the room. And sometimes that adult is just charging you Ferrari prices to deliver Honda performance. So why do smart people stay in these funds? 3 reasons. 1. The percentage illusion. Your brain sees 1% and assumes it's trivial. But 1% of a growing portfolio over 30 or 40 years is not trivial. It's massive. 2. The authority effect. If an advisor in a suit, a benefits portal at work, or a fund with a polished name says this is professional management, people assume expensive means better. We do this with wine. We do this with watches. We do this with legal services. But investing is one of the few industries where higher cost often predicts lower net performance. 3. The invisibility of the bill. This is the killer. If you had to manually write a $3,200 check every year to your mutual fund provider, you'd be on Google by noon looking for alternatives. But because the fee is quietly skimmed from fund assets, it never triggers the same emotional alarm. I call this the silent invoice effect. If the bill is hidden, outrage disappears. And when outrage disappears, overpayment becomes normal. Ask yourself one question. If your fund company had to send you a yearly email with the subject line, "Here's exactly how much of your retirement we took this year," would you still own the same fund? For a lot of people, that answer is no. And this is where it stops being theoretical. That missing $200,000 or $300,000 is not abstract. That's not spreadsheet money. That is 5 more years of work, a smaller monthly retirement income, less margin in a bear market, less ability to help your kids, less ability to absorb healthcare costs, less ability to say no. That's what high fees really steal. They steal optionality. And optionality is freedom. This is why so many people who did everything right still reach their 50s and 60s feeling trapped. They worked, they saved, they invested, they delayed gratification. But inside the account, there was a tiny leak they never learned to see, and over decades, that leak became a canyon. It's not your fault. Nobody in school taught you how expense ratios compound against you. Your employer probably handed you a menu of funds and assumed you knew how to decode it. Your advisor may have had incentives you never saw. The system counts on passivity because inactivity is profitable. So how do you get out? I call this the fee escape framework. 4 steps. Step 1. Audit the damage. Open your 401k, IRA, brokerage account, or old rollover account. Look up every fund you own. Find one line, expense ratio. That's it. You're looking for the permanent toll booth. As a rough rule, for broad index funds, you generally want ultra-low fees. If you're seeing 0.03%, 0.05%, 0.10%, even 0.20% for many plain vanilla funds, you're usually in sane territory. When you start seeing 0.80%, 1.10%, 1.50% on mainstream stock funds, that deserves scrutiny. Red flag doesn't always mean automatic sell, but it means explain yourself. Step 2. Separate complex from core. Most people do not need complex strategies in the core of their retirement portfolio. Your core is not where you buy the financial equivalent of truffle oil. Your core is where you buy exposure. Broad U.S. stocks, international stocks, maybe bonds depending on your plan. Boring is good here. Boring is efficient. Boring leaves more return in your pocket. Step 3. Calculate the real price in future dollars. Do not ask, what is the fee this year? Ask, what is this fee likely to cost me over 20 or 30 years? That mental shift changes everything. A 1% fee is not a yearly inconvenience. It is a 6-figure claim on your future self. Once you start pricing fees in lost retirement years instead of basis points, the spell breaks. Step 4. Stop outsourcing your confidence. This one is psychological. A lot of people keep expensive funds because complexity feels safer. It feels irresponsible to choose the simple option. Like maybe the complicated product must be better because it has more moving parts. That's ego, that's status, that's fear dressed up as sophistication. Sometimes the mature financial move is accepting that you do not need a genius to outperform the market. You need a system that doesn't sabotage compounding. That requires a little ego death. You stop trying to look sophisticated. You start trying to keep more of what the market gives you. Step 5. Make the switch intelligently. Now, important caveat. Not every account should be handled the same way. Inside tax-advantaged accounts like many 401ks and IRAs, switching funds is often much easier because you typically aren't triggering immediate capital gains taxes when you rebalance. In taxable brokerage accounts, it can be more complicated because selling appreciated holdings may create a tax bill. So this is not panic sell everything tonight. This is stop the bleeding intelligently. Maybe that means redirecting all future contributions first. Maybe that means exchanging one high-fee fund inside a retirement account. Maybe that means building around a bad legacy holding while you plan a cleaner exit. But the point is the same. Once you see the leak, you don't keep pouring water in and hoping it fixes itself. Here is the key insight. So the real product Wall Street sells is not investment performance. It's permission to stop thinking. Don't worry, we've got it. Don't worry, it's only 1%. Don't worry, professionals are handling it. And that emotional convenience can cost you hundreds of thousands of dollars. The brutal truth is this. For most long-term investors, the battle is not won by finding a magical fund. It is won by avoiding unnecessary friction. That's it. The difference between retiring with dignity and retiring with anxiety is often not some genius stock pick. It's avoiding a handful of silent, permanent drags on your compounding. And fees are one of the biggest. The 1% fee isn't dangerous because it looks big. It's dangerous because it looks small. That is why it survives. That is why millions of people ignore it. And that is why it keeps working. So let's summarize the autopsy. A 1% mutual fund fee sounds harmless. It isn't. Because when that fee is charged every year on a growing portfolio, it compounds against you. Over 30 years, that tiny leak can cost you around 1/4 to 1/3 of your final wealth. At 2%, the destruction can be even worse. This is not a spending problem. This is not a discipline problem. This is a systems problem. You aren't bad at money because you missed it. The bill was designed to be invisible, but now you can see it. And once you can see it, you can stop funding it. Stop optimizing for the appearance of sophistication. Start optimizing for ownership. Stop paying for the feeling that someone smart is watching your money. Start building a system that lets your money stay yours. Because wealth is not about having the fanciest strategy. Sis, it's about preserving your claim on your future. Every unnecessary fee is a tiny act of surrender, and over a lifetime, tiny surrenders become permanent dependency. So this week, audit one account. Just one. Look at the expense ratios, and if you find some absurd mutual fund charging you 1.3% to hug the same stocks an index fund owns for 0.03%, drop it in the comments. I want people to see how common this is. If this video helped, hit like, subscribe, and share it with a friend, coworker, or parent who still thinks it's only 1%, because that sentence has probably cost more retirements than almost any bear market ever did. And remember, the goal is not to impress people with complexity. The goal is to keep more of your life.